When do late cycles end? Recent volatility in equity markets, in particular in the US market, has investors thinking about the end of the cycle. Expectations of a slowdown in growth over the year ahead, combined with or partly as a result of tightening policy moving up towards neutral, rising bond yields, rising wages growth, all these factors have fed into the, I guess, a belief or a risk that the US cycle is coming to an end. So in this short video, we're going to investigate some of the factors behind cycles and what causes them to end. So in terms of the evidence that we should be looking for. So what we're looking at here now is just reiterating what we did in the last video, was the fact that late cycles vary in length. And on this particular chart, we're looking at previous late cycles, and we're using the unemployment relative to Nauru as the definition of cycle phases. And what we see at the moment, the black line is the current cycle. So the US economy has been below what has been estimated to be Nauru now for about 18 months. And in fact, we've seen on 3 previous occasions where the cycle has lasted around this time, or the late cycle phase has lasted around about 18 to 22 months. This is since 1978. We did indeed have a period in the late 90s where it lasted quite a bit longer. And if we go back to the 1960s, we've seen late cycles last anywhere up to about 65, 66 months. So we're at that point where questions need to be asked about 18 months in to the late cycle phase. And as we pointed out in the last video, returns can be quite strong during the late cycle phase. And that's what's showing here, point 0 being the beginning of late cycle unemployment through Nauru. We saw a return from equities in 1978, which is the light pink line, of around about 20%. In 87, the market rose about 60% in this late cycle phase. In 97, the long one rose about 80%, 30% in 2005, as we see there, and on this occasion it got as much as 25% higher before pulling back in October. So the returns have historically been quite strong in this phase. As you can see, the period, as we just discussed, has typically been around about the 18 to 22 months period, although we have had longer late cycle phases. So why is this all important? Well, I guess we need to think what's typically on the other side of late cycle, and the way the cycle and the sequence of cycles tends to unfold is that the next phase is a very difficult period typically for equity markets. So this is what we call early downturn, and this is typically the economy, the rate of growth in the economy slows such that unemployment begins to pick up. And so you can see the returns from equity markets during previous what we call early downturn phases, declines of anywhere up to 30%, quite sharp. There has been one occasion where it did rise for a period back in the 1960s. So it is an important juncture, and it's no wonder that markets are sort of starting to build in a little bit more volatility and build in risk that in fact we might be moving into this phase. So we just want to now investigate some of the catalysts for moving out or exiting the late cycle phase and into the early downturn phase. Of course, one of the first areas to look at in terms of identifying an exit from late cycle and into early downturn is to look at Fed policy. And so in this chart, we're looking at the real Fed funds rate relative to a neutral Fed funds rate. And on this chart, 0 being the point here at which policy moves into restrictive mode, and these are the months prior to the beginning of the early downturn. So 0 represents the early downturn, and what you've seen certainly in the last 3 cycles since the late 80s is policies move to a restrictive position somewhere between 12, perhaps 15 months prior to exiting late cycle and moving into early downturn. And on those 3 occasions, policy has gone about 100 to as high as 150 basis points above neutral. So we're of course nowhere near that at the current juncture. We look at where we currently sit. So this is basically the same chart. So this is the Fed funds relative to neutral, and the shaded periods here are the early downturns. And you can see here a slightly different environment, a high inflation environment back in the 1980s. Certainly in the late 80s, policy had gone about 170 basis points above neutral. around about 12 months prior. During the late 1990s, policy had gone restrictive quite a bit earlier, only to be eased up during 98 as the LTCM and emerging market and Asian crisis impacted markets, and then was retightened as we went into 2000. So that, if you like, extended this late cycle phase, but policy had been tight for some time. And again, in 2005, policy moved into restrictive zone around 12 to 15 months ahead of the eventual beginning of the early downturn. So we're not quite there as at this point. We probably think that neutrality, which itself is a difficult concept to measure, the Fed estimates its neutral policy will be around about 0.9 real, so 2.9 nominal, so we're at least two tightenings away. So by late 2019, we might expect policy to be moving into a restrictive stance. So we're still some time away before we reach that that position. What else might we consider? Well, of course, the factors that drive Fed policy cycles will be wages growth. So I'm just going to, and inflation. So we're just going to grab some series here on inflation and on wages growth, if we can find it. So what I'm looking at here, this is average hourly earnings for production workers. So once again, I'm going to focus more on the 1980s onwards, or the late 80s onwards. And we can see on this chart, again, the shaded periods of the early downturns. The blue line represents annual average hourly earnings growth, and you can see there on the last three cycles, sort of average hourly earnings has moved up to the sort of the 4% range in the lead up to the downturn. So we're currently sitting at about 3.1%. Now let's have a look at that in terms of an event. As we saw before, so 0 is the beginning of the early downturn. We're going sort of 20 odd months prior, seeing the pattern in wages growth. You can see wages growth on average has gone from about 3.1% in the 18 months prior to about 3.5 to 4% in the 12 to in the 6 to 12 months prior to the rolling over in the cycle. So you know, the recent lift in wages is certainly a cause for concern. The wages can push up fairly sharply, I think, as we saw on a couple of occasions here, certainly in the late 80s, where it picked up from 2.6 to 3.6 very quickly. And of course, in 07, it picked up from 2.6 to about 3.9 in the space of about 12 months. So it can happen fairly quickly. So this is another reason why I think the market's been a bit concerned. But what we'd suggest is that at 3.1, and we're still some way off moving into this bracket of 3.5 to 4%, but that is the sort of catalyst we think that investors need to focus on for identifying signs of the US economy tipping into an early, or potential or risk for tipping into early downturn phase. And finally, we're just going to have a look at some core inflation numbers. I might use the, actually we'll use the price, core PCE price index. That now is the pink line. You can see certainly in the late 80s, inflation, this is the Fed's preferred measure now, sort of moved up through 4%. Back in 2000 or 99, it moved up into around about the 2%, slightly above 2%. In fact, probably what the better series to use is the CPI, which is what I'll bring in here now. And if we use the core CPI, it makes it a little bit clearer. So in 2001, core CPI picked up to around about 2.5%. Likewise in 2005, 2007, before the downturn. And of course, it was higher back in the late 80s. So for us, the key will be looking at wages growth, a push up in wages growth into the 3.5% and above area. We're currently sitting at 3.1. Inflation probably looking at 2.25, 2.5 as being a bit of a catalyst for a potential more aggressive move in the Fed to an above neutral or a restrictive stance. We still feel, but all of those factors are a little way off. That what we saw in October was a bit of a dress rehearsal, however, for something that could become a much more frequent observation over the next 12 to 15 months. Thank you.